As things get even hairier with our economy, there are some new concerns and some new really interesting developments around home mortgages that I think you're going to be pretty shocked to hear, and could absolutely change everything in real estate. I'll show you my findings and a lot more as I take you beyond the headlines with today's 10-minute breakdown. Coming up. I'm Lynette Zhang, Chief Market Analyst here at ITM Trading, a full-service gold and silver dealer specializing in custom strategies to help you survive and thrive the crisis that, frankly, has already begun. And today we're going to talk a little bit about real estate, among other things, because we just did a video recently on muni bonds. And then, lo and behold, America's housing crunch is so bad, it may hurt city bond ratings. Why? Because the affordability factor for these homes is also out of control. It's way beyond anything that the average person can afford, which means that they move or they downgrade, and that hurts income for the municipalities, the states that are issuing these bonds. You know, incomes have not kept pace with the increase in real estate and housing, and cities count on that and states count on that to generate their income. In fact, you know who recently counted on it a lot? Washington, D.C. And they joined the muni selling spree with record bond deals. Actually, what they're talking about here is that there has been, let's see, the nation's capital plans to sell about $1 billion of bonds to refinance, mind you, this is not new, this is refinance the debt they've already issued and pump some money into community revitalizations. It comes amid a flood of activity from municipalities that pushed the amount of bond sales this year up 20%. Okay, so yeah, I mean, cities, counties, they're taking advantage of these low interest rates, but what they're missing is that these bonds, at some point, you're not going to be able to roll it over. And especially when you look at the heavily indebted cities like we have. In addition, the District of Columbia, D.C., well, they used to actually trade at a premium, that's this black line, to AAA 10-year benchmark. But now they trade right with it. So you're not getting paid for the risk. Now, this is the piece that I was talking about that I find really, really interesting. I am intending to do a lot more research on this. I pulled up some government reports. I haven't had a chance to do that yet. But I wanted to bring this to your attention. Okay, you have two kinds of mortgages: recourse mortgages and non-recourse mortgages. In a recourse mortgage, let's say you take out a $300,000 mortgage and then you default on that, and the bank takes your house back and they can only sell it for $250,000. In a recourse mortgage, you would be responsible for that other $50,000, so they can attach your paycheck or other assets, etc. With a non-recourse mortgage, then you walk away from the house and then they have to eat that other $50,000 as a loss. Well, in this court case, it's really interesting. City Mortgage had purchased a bunch of homes from Equity Bank, blah, blah, blah. And 12 out of 12 of those mortgages that are in dispute, 6 of them had already been foreclosed. So they went to court over this. The court ruled that they agreed with Citi. Let's see, in a disagreement, the parties would settle or could write off the loans. Okay. However, there was reason to press on. 6 of the 12 loans had been foreclosed, and Equity Bank made the remarkable argument that foreclosure and resale meant that the mortgage loan no longer existed, meaning that there was nothing to repurchase as they had promised. They had a recourse. They had a recourse agreement with City Mortgage. Okay, the bank ruled in their favor, and part of the ruling relied on the language of the contract, but the court's interpretation of the language assumed that Equity was right, that foreclosure extinguished the loan. In other words, was non-recourse when these mortgages or this deal between Equity and City were recourse. City Mortgage does not explain what exactly Equity was supposed to repurchase without evidence of what, if anything, remained of the underlying loans. So, in essence, what they actually then said, because this is going to be used as precedence, I'm sure they're going to go back into court, but basically this ruling establishes precedence for all mortgages to be non-recourse. Now think back to 2008 and all of those mortgage holders that defaulted on their loans and had their houses foreclosed, they walked away. And of course, the banks were made more than whole and compensated, but basically the homeowner was able to walk away. I gave you a list here so you can go into the blog and see it of all of the states that are non-recourse states, so they can't even write other kinds of mortgages in there. But that is a game changer potentially. So we have to keep our eyes on that and see exactly what happens with it, and I will be doing a more thorough report on that in the future. Now, the reason why I'm bringing up WeWork in here is because they just posted their losses, and thank goodness. I mean, do you guys realize that if they had brought WeWork public either in December or January or something, or November, that they probably would have had somewhere in the realm of a $48 billion valuation. But recently they actually were bailed out by SoftBank, who has a huge stake in them, to prevent them from going under. I don't know whether or not that's going to be true, because their occupancy rates have dropped, their losses have grown, and they're sitting on less cash, even with that recent cash infusion. The reason why this matters so much is because WeWork has gone in and bought up commercial, a tremendous amount of commercial real estate in different cities around the country. And so if they go under, there's going to be a lot of new commercial real estate that is coming onto the market. This is not a good thing. So it isn't just whether or not SoftBank has done it, because WeWork on their own took out a tremendous amount of debt, as have SoftBank, to fund a lot of their unicorns and their spending. So I think that this is a huge crack between what we just looked at and other things on what is actually happening in the real estate market, including this headline: JP Morgan steps on Freddie and Fannie turf, because what they've come up with is a new product called a credit risk transfer. Last month, they became the first U.S. bank to issue credit risk transfer tied to pools of mortgages, because CDOs and mortgage-backed securities and lots of other things were not enough. They have to leverage it even more. The bond-like instruments have been embraced by government-controlled mortgage guarantors Fannie Mae and Freddie Mac since their introduction in 2013. So it takes the place of those CDOs. Investors will shoulder losses up to a certain level if homeowners default on loans in the underlying pool of mortgages. In essence, JP Morgan has bought a type of insurance on loans it has already made to borrowers with higher credit scores, that in turn should allow it to hold less capital against those loans. Now, here's the thing. When we go into a global slowdown, everybody's going to be impacted. So taking into consideration the recourse and non-recourse loans, I'm going to pull all of this together. Bear with me. I'll get that done as soon as I can. But it's really a very big deal. The other thing that I need to talk to you about is what happened when Powell was talking, Fed Chair Powell was talking in front of the Senate Banking Committee. And basically he's saying the new normal is low interest rates, low inflation. And I say that with a little bit of a catch because, you know, your cost of living is going up. So whatever they want to say. But look at this budget deficit. We're close to $1 trillion now. We're not done with the rest of the year. Well, this is the year end actually for the U.S., but they're pushing interest rates down. Remember, there's that battle that's going on. Markets want to push the interest rates up, but nobody can really afford that. And the government has a very bleak outlook for government debt because, let's see, this is on a report that Moody's published, that political and geopolitical turbulence is exacerbating a slowdown in the trend GDP growth. And we know globally that's going down. They talk about the emergence of influential populist movements, and we're going to see that very shortly in this country as well. Real quickly, there is a severe pension crisis. We know that. They're expecting 15.8 trillion. I mean, these pensions are in all sorts of illiquid assets. But this is the key, and then I got to close. Why the Fed is losing potency. This is the monetary velocity, the speed at which money changes hands. We saw it turn up a little bit here. It has turned down again. Remember I said, when this starts to go up in a pervasive way, then we will know we have entered hyperinflation. So, and there's only one way to fight deflation, and that is with inflation. So that's it for today. Have a great weekend, and I will see you next week. Be careful out there. Bye-bye.